Gold just hit a fresh all-time high, $3,176. But this isn't just a sensational headline, it's a symptom of a larger story. The world is hedging against the system itself. While gold shines brighter, the US dollar loses luster. The dollar index has slumped to a 6-month low after failing to maintain its 200-day moving average. Credit default swaps now reflect a disconcerting reality. The U.S. is perceived to have a higher risk than France and South Korea and is almost on par with Italy and Greece. Think about that for a moment. This isn't merely about negative data or unpredictable policies. It's a growing crack in confidence, impacting not just the U.S. economy, but the foundational system supporting the dollar, the Treasury market, and global risk assets. Traders are worn out and liquidity is thin. The basis trade in the Treasury market is unraveling again, tightening funding conditions and escalating volatility. On the equity front, it's a bloodbath. Major indices reverse sharply after a midweek rally, failing to sustain momentum. The VIX surged to 55 before settling near 50. This isn't normal volatility. It's systemic stress seeking reevaluation. The narrative around tariffs is losing credibility. Investors are now viewing them as potential drivers of structural inflation, feeding stagflation fears. Recent CPI and jobless claims data have eased some stagflation worries, yet the crucial question remains, are we experiencing healthy disinflation or merely collapsing demand? Only sustainable outcomes matter. Long-term yields have spiked, with the 30-year bond rising over 13 basis points despite a strong auction. This could be attributed to inflation concerns, supply issues, or a resurgence of foreign selling. Rate cut expectations rose modestly, now a 50-50 bet on 3 or 4 cuts in 2025. Gold isn't just shining, it's in a frenzy, posting the biggest 2-day surge since the lockdown lows of 2020. Investors seek more than yield, they seek trust. When trust diminishes, centuries-old gold takes precedence. Here's the crux of the matter. While last Wednesday's rally offered a temporary relief from worst-case scenarios, underlying risks like recession, stagflation, and policy uncertainty persist and are intensifying. This fleeting rally was a mirage, and the reality of unwinding is here. So, what's the action plan? Stay defensive. Emphasize quality. Maintain high liquidity. Don't confuse volatility with opportunity unless you've diligently done your research. Complacency is harshly punished in this climate. Until there's a clear pivot from the Fed or a reversal of tariff policies, market fragility will remain. Every surge could be a trap, each dip a deceptive opportunity. Thanks for tuning in. If you're monitoring these shifts too, hit like, subscribe, and leave a comment. What's your go-to hedge, gold, Bitcoin, or cash? Stay smart and stay agile.